Good afternoon, everyone. I can see hopefully all of you have now made it into our main session. I'm sure many of you have come across me by now, but I'm just going to give a quick introduction. So I'm Manveen. I'm the Learning and Insights Manager here at the MGAA, or Managing General Agents Association. Delighted to welcome you to our professional optics session today, delivered by LexisNexis Risk Solutions Insurance UK&I. Before I hand over to Heike to talk about closing the data gap in commercial property, just going to run through a few housekeeping points, which I'm sure, again, many of you may have heard of for those that do attend these sessions and find great use from them. You will notice that you don't have access to your camera and microphone at the moment. Please don't be alarmed. It's just so we're maximising the bandwidth for the presentation to minimise disruptions, but you shouldn't hopefully find any impact to your ability to engage with us today. We do have the chat function available for you to ask questions and encourage you to ask questions throughout. We'll probably cover this in the main Q&A piece, and then we'll also be able to enable camera and microphones should you want to speak and engage with Heike and our presenters directly. You will also find that there's an opportunity for you to share your feedback with us at the end. I'll pop a quick link to our feedback survey. Please do take some time to give us your thoughts and feedback. Should take no more than 2 minutes, and also make sure we can continue delivering good content for you. We are recording today's session, so it will be available post-session for you to refer to anything that you may want to revisit, but you can also reach out to Heike directly. We do ask that you don't use any AI note-taking tools during the session, as we don't have permission of everyone attending for these to be used. And then one final point from me: if you find this supports your learning needs, you can include this on your CPD log. So please do consider whether or not it meets your learning objectives or learning needs, and consider including it this way. So that's all from me. It leaves me to introduce today's session and hand over to Heike, who's going to talk to you about closing the data gap in commercial property. An exciting session awaits. I'll hand over to you, Heike.
Excellent. Thank you very much, Manveen. Today I'll be looking at closing the data gap in commercial property. A little bit about myself. So I'm Heike Vasanto, originally from Finland, but I've been living in Ireland for the last 10 years. I'm based out of our Dublin office, where we have quite a large team of data scientists focused on developing new insights for kind of the insurance and MGA markets to assess commercial property risk more accurately. I originally did my undergraduate degree at the University of Glasgow, where I studied history and geography. I was actually looking at how in the 17th century, a Scottish minister, Timothy Pont, and a Dutch atlas publisher, William Blauw, made Scotland into the best mapped country in the world. Now the technology has changed a little bit, so we're no longer relying on a minister physically walking all across Scotland with a sketchbook. But we are still seeing surveyors going out to commercial properties to assess the risks. So in some ways, we haven't come that far. So I primarily work with geospatial data, which ties in very well with commercial property insurance. And we work very closely with some of the leading insurers and MGAs in the UK. We also work with a lot of third-party data providers like the Ordnance Survey, the British Geological Survey, and flood data providers like Twin and JBA. And the wealth of data that's really coming available and accessible makes it a very interesting time to be involved with data and working in the insurance industry. And we're constantly looking at how we can enhance our commercial and home property insurance products here at LexisNexis Risk Solutions, and finding innovative ways for clients to make the most out of the extensive geospatial data we have available. And so that's what kind of today's session is about: understanding where the data gap exists in commercial property underwriting and how we can start to address those gaps. And thank you, Manveen, again, and the MGAA for hosting this, and I hope you find it useful. So today I'll cover 4 key areas. So first I'll go over into a market overview. So we're going to have a look at the current state of the commercial property market in the UK. Then I'll walk you through some key challenges and pressures MGAs are facing, particularly around data and decision making. From there, I'll go into how geospatial intelligence and specifically our LexisNexis MapView tool can help address those challenges in practice. And finally, I'll touch on what's next for the industry, how we're moving towards a more complete 360-degree view of commercial property risk. Setting the scene a little bit, so the UK commercial property market is very large and it's still growing. So the UK commercial property market is approximately 15 billion in gross written premium today, with steady growth, and it's potentially going to double over the next decade. So it is a very large market and a growing market. But what's really interesting is how that market is evolving. So we're currently going through a soft cycle, and that looks to be continuing into 2027. So rates are coming down and competition is going up. So that means that margins are getting squeezed. At the same time, we're seeing quite a mix of underwriting rules, and those are changing. So some insurers are loosening those underwriting rules just to win business, whereas some companies have much tighter rules to avoid losses. So we're seeing kind of different ways to approach the softening market. And these decisions are being driven by data, governance, and the true risk quality rather than just property type. So a lot more data is becoming available. And MGAs are also playing a much bigger role. And with AI and richer data sources coming into play, insurers will become far more selective. So really cherry picking some of those best risks. I recently just got an invite into an event which described this as the golden age for MGAs. Not sure if everyone would agree, but certainly we're seeing over 300 MGAs now active in the UK. So certainly a very large part of the UK market. With the emergence of better data, kind of brokers and MGAs who cannot provide rich and accurate property data at the point of quote specifically will start losing business. And the question is no longer whether data matters, it's whether you have the right data at the right moment in the right workflow. So we work kind of across the insurance market, and we're seeing kind of consistently 5 key pressure points. So one of them is incomplete risk data. So for example, if you don't know the construction type, the occupancy, building height, business activity, or nearby exposures, you're effectively pricing with blind spots. Then underinsurance has been a real issue for a while now. So the majority of commercial properties simply aren't insured to the right rebuild value, which creates problems for both insurers, MGAs, brokers, and customers when a claim hits. Then obviously, well, the climate, so it's been kind of constantly evolving. But in the UK, we're particularly seeing kind of the risks with flood and subsidence increasing. And we're also seeing windstorm, for example, which recently has been a very large driver of claims, like we had with Storm Eowyn last year. It knocked out my power for a few days, and Ireland was very badly hit. So there was over 1 million properties without power, some for up to 2 weeks. And we're also seeing some more emerging risks as well. So for example, wildfire being driven by hotter summers and drier winters. Another one then is speed. So in the e-trade era, fast quoting is a critical differentiator. So slow responses lose business. And while straight-through processing is the goal, data gaps are the main obstacle for implementing that. And then finally, we have inconsistent location data. So location data is widely available and used across the industry, but its application lacks consistency. So different providers rely on in various ways, using different types of data at different times for different purposes. And that results in an uneven playing field. So what does that mean as a cost for a data gap? Well, it is quite interesting. So we're seeing that 77% of insurers report incomplete risk for evaluation. So that means that the data that's coming in from their brokers or from the customers just isn't complete, and that seems to be the case most of the time. And that then leads to 70% saying that inconsistent underwriting decisions are being done as a result of that. So they don't have the right data, and they're unable to get it from the customers or their brokers. So, and then from the underinsurance perspective, 71% of commercial properties are underinsured. So most of commercial properties are underinsured, and kind of they're only covered for a fraction, or 67% of their true rebuild cost on average. And that's a kind of a direct consequence of missing or inaccurate data at the point of quote. And we're seeing escalated climate losses, so it's becoming a much more difficult time for the climate. So we just saw 6.1 billion, which in 2025 in UK property payouts, and that was the highest in 17 years, according to the ABI. And weather-related claims doubled the 2017 to 2020 average. And if you don't have a right view of your accumulations, then you can't really see your true exposure to the climate. And that's something that's going to consistently get worse as we see kind of climate change escalating. And then the race to straight-through processing. So 90% is the target for straight-through processing. So we are seeing kind of leading insurers increase the limits as well. So kind of SME premiums have grown from 1 to 2,000 from a STP perspective, and now that can be up to 10,000 plus. But kind of the enrichment gaps and data gaps are kind of holding back the increase of that. And it really has changed quite fast as well. You don't have to go back very many years for that 1 to 2K to have been the limit of STP, but we're seeing that develop quite rapidly. So what can we then do to close the gap? Well, closing the gap is really about simplicity and timing. So it's delivering the right data exactly when you need it. So you need to deliver it at point of quote. So with enriched property, business, and peril data flowing directly into that workflow. But it doesn't stop there either. It should flow across the full life cycle of that business, or through from kind of onboarding through to claims and through to renewal. So throughout the whole insurance continuum. And critically, it needs to be delivered through a single integration. So one interface, multiple data layers, removing the need to stitch together multiple vendors and giving underwriters a consistent and trusted view of risk. So this is what we in LexisNexis Risk Solutions like to call our insurance continuum. So it means that we can provide a wealth of data throughout, kind of through one single entry point, but it can be used throughout the full life cycle of a property. So we can have it from marketing, contact, quote, underwriting, renewal, compliance, and claim. So kind of similar data sets, although some tailored solutions for those kind of specific parts, and they can be delivered kind of at all points of that journey. So that means at point of quote, you can get enriched property data and perils data available instantly, but then also across the full life cycle. So from acquisition down to renewal and claims. And critically, it's all done through a single point of entry. That means that you're not stitching together multiple data sources, and that's kind of really simplifies adoption, and kind of because complexity is one of the main barriers for adoption. So then I'll have a look at our map view platform. So this is the LexisNexis map view. So we are one of the leading providers of location and risk intelligence solutions for the property insurance industry. So we're empowering customer with critical tools and insights. So we're increasing underwriting profitability, kind of maximizing business growth, and realizing cost savings through reduced claims and reinsurance costs. And I have some numbers for that as well after the demo. And it's an underwriting and exposure management software platform, and it's delivered as a software as a service to the global property insurance market. As some numbers, so it's currently used by customers for both manual and automated underwriting. So we have about 8,000 commercial lines underwriters using it on a daily basis. And that's it's also being used quite heavily in an automated fashion. So we're seeing about 100 million automated transactions per month. So kind of critically, any of the scores and the tools that are available through the user interface, the software as a service part, can also be then delivered directly through our IQ platform, directly at point of quote. So it makes it very flexible in how it can be adopted, and you get the same view through all of your channels. And we have a good kind of competitive position. So we have about 60% of the market, used currently by 35 primary insurers. And it's available in Ireland, so both Northern Ireland and the Republic of Ireland. We also have customers in Canada and obviously in the UK as well. And it's being used by MGAs, brokers, and direct insurers. So brokers would mainly be using it as a delegated authority, so you can tailor the tool to show the brokers exactly what you need them to see so that they can price accordingly. So I'm going to jump into a live demo now. So let me just share my screen. So what you should be seeing now is a map of the United Kingdom, or at least most of it. We can get Shetland in as well. So this is what a user would see as they log in to the platform. And this can also be tailored quite specifically for the type of user that is using the tool. So if you had brokers using the tool, they could be specifically set up to just see the perils and the information that you want them to see, that they need to kind of be able to do a quote. What we see is on-cover policies. So this is just a kind of a demo book of business that we've created for this demo account specifically, but it could also be very tailored as well. So we have a number of customers who are splitting this out. So you would split out potentially your commercial book and your property book or even your motor book. So especially with, we're seeing kind of more interest from motor as well from an accumulation perspective. And it's available with single sign-on, so you don't have to worry about creating user accounts. And also all of the data that's available through the user interface is also available through the API connections. So what we see for this book of business, you get a quick overview of the book itself. So we have about 500,000 risks on cover, with a total sum insured of about 400 billion. And in the layers, we have kind of information on kind of what peril layers we can have as well. So, but let's have a look at a property. So I'm going to search for a property here. So this is 125 London Wall. So this is actually our new offices in London are here. And I find it's quite an interesting building because it kind of straddles the actual road. So it's architecturally interesting, but also kind of geographically quite interesting. So it goes over the road itself. So that's kind of an intersection under the building itself. And what we get when we search for a property, so we have kind of an ordnance survey address-based geocoder, but you can also search with Google or using kind of a policy lookup as well. But what we see is the kind of a couple of things highlighted. So the green outline here is the full block that is kind of the full contiguous kind of building fabric. whereas the darker shaded one is the building outline itself. You can see that they don't quite match up with the base map here. The reason being is that we use kind of Google Maps for the base map, because that's what a lot of people are familiar with, but the blocks themselves and the building data is coming from the Ordnance Survey, so it's extremely accurate, the building footprints. And what we see the blocks being used for quite heavily is around aggregation. So if you have a number of policies that are being underwritten within the same contiguous building fabric, those would be exposed if there was a fire that was to occur in that building. So it makes accumulations a lot more accurate than if you were just using radial accumulations. But we do have radial accumulations as well. So you get your 10 meter, 25 meter, 50 meter, all the way out to 500 meters. But that's also configurable for each kind of setup of MapView. And we can show the details of those accumulations. So in this case, in a 10 meter radial accumulation, we have 2 policies and 1 million in total sum insured, whereas up to 500 meters, we have over 300 policies and almost 300 million in total sum insured. And within the blocks themselves, so we see the primary block. So primary block is the green one. So that would be what would be immediately exposed if there was a fire within that building fabric. And the secondary would be then kind of any that are kind of nearby. And that's actually a threshold that's determined by the customer. So in this case, if it's within 20 meters of that primary block. So one thing we have noticed is that in London, so you can have quite large blocks. So what we do is we stitch together all of the Ordnance Survey building footprints if they're within kind of touching distance, or if they're within a certain tolerance. So we use 1 meter as the tolerance for kind of stitching it together. But that can lead to quite complex blocks, especially here in the Barbican, where we see these covered walkways. So you can also then split these blocks out. So if you feel that, well, that's probably not a risk for fire to actually spread along that covered walkway, you can simply just split it out. Oh, sorry, I need to select it first. So that then, and you can do multiple splits as well. And that's actually something that's come into play quite recently. So we just saw a major fire up in Glasgow. So here we have 101 Union Street. So this was recently, just back in March, we saw a major fire that started from actually a vape shop that was located kind of towards the southern end of this building. And then it spread out quite rapidly and kind of destroyed this B-listed building on the corner of Glasgow Central Station. Now, luckily, it didn't spread out of that building fabric itself or of the building footprint itself. So Central Station was spared as part of this fire, but certainly still a significant fire event. And there was kind of business disruption as well in the secondary blocks and in the primary block as well. So Glasgow Central Station was shut down for a number of weeks. And there's still been business interruption going on in the area. So the road outside actually is still closed off due to the danger of the building collapsing further. And it kind of resulted in a dozen businesses being destroyed as well within that block. And Glasgow itself is no stranger to fire. So we only have to scroll up a little bit towards the north here. We have the Glasgow School of Art. So this was also had a very significant fire event in 2014. And we can actually see the remnants of it still. If we switch from just the road map to the satellite imagery, we can see that there's still a tarpaulin on the actual Glasgow School of Art. So that's the famous Charles Rennie Mackintosh designed building. And it was was exposed to fire twice. So originally in 2014, it caught fire. Luckily, the fire department responded very quickly to that one, and they had good knowledge of the building, so they were able to put it out with only 17% of the building engulfed in fire. Unfortunately, then during the reconstruction, another fire broke out in 2018, and in that case, there was actually a delay in the fire alarm, which resulted in a much more significant fire. So another thing just to highlight is that you can either search for a building, or you can right-click and do perform analysis here. So here we can see that the main block was the kind of the art school itself, but within that primary block, there was also the O2 Academy. So as I said, I studied in Glasgow, so I have many fond memories from late nights at the O2 Academy and the Jumping Jacks nightclub as well. So these were then engulfed by that fire within that primary block that spread from the Glasgow School of Art. Another thing you can then jump into quite easily is to get a picture of what the building looks like on the ground. So if you just right click, you can just jump into Street View. So we can see that even though kind of fire was back in 2018, we're still seeing some significant kind of construction work still going on. And same on the other side with the Glasgow School, with the O2 Academy. We can see that it's still completely derelict along with the full block, so some significant business interruption there. Next up, we'll have a look a little bit further south. So I'm going to zoom into Twickenham in London. And I'll just switch it back over to the road layer so it's a little bit clearer on the buildings themselves. And something that we get when we do this analysis is we see a highlight of how many issues are impacting the property itself. So for this Kestrel House, for this business address, we can see that there's 4 issues highlighted. So depending on your own configuration, you can decide what issues you want highlighted. In this case, what's come up is combined flood. So there's flood risk at the property, and TOFCAT 5, which is the total occurrence factor of subsidence risk in a 1 to 5 scale. So this is 4, so it is very high. And then we have risks of burglary and vehicle crime as well. So these are our own crime scores. And what we can then do is we can look at a little bit more detail as well. So if we click on the show details, so what we have is the primary driver of this combined flood risk is river flood. So if we open up the overlay for that, we can see that the blue is now highlighting the areas of high flood risk. So we can see that there's heavy flood risk, so from a river flood along Heath Road. So this is being driven by the River Crane up here, potentially during a high rainfall event, would burst its banks and then kind of flow down, making its way to the River Thames here in the east, kind of along the path of least resistance, which happens to be Heath Road. But something I'd like to point out here as well is that while this does come up as a very high risk of flooding, so 14, it might depend on how you're looking at flood risk on the actual score that it would be highlighted as. And this is particularly important if you're looking at this from just an API perspective. So if you're not seeing the visualization of the flood risk, because it's quite obvious here that there is flood risk here. But if you just got these scores through the API, you don't get the full context as well. And depending on how you score this property, so if you're just looking at where the address point lies, there's actually no flood risk for that property. But in this case, we're scoring using the building footprint, so the full kind of extent of the building, which gives you a 14, which is an extremely high flood risk. Other options for scoring flood is using a buffered score. So we support all of these options. So you can use a 10-meter buffer, 25-meter buffer, any distance of buffer that you want. So in this case, any buffered score, at least the 10-meter buffer, would result in flood risk being identified. But that's not necessarily always the case. especially if you're looking at some more complex commercial properties. So here we just have an industrial building where kind of the building footprint extends out quite far from the address point. So using a 10-meter buffer wouldn't capture any risk for this property, or even potentially a 25-meter buffer. You might get a very low flood score. Whereas using the building footprint, you get a combined flood score of 9, which is quite significant. And we can see the reason for that is kind of towards the southern end of the building. That happens to be where that flood risk is associated. So by using a visualization tool, it gives you a lot more context about that flood risk. But using the building footprint, you do get those scores more accurately, even if you're just using kind of straight through processing and an API response. Got another location here as well where the flood risk is actually across the road. So in this case, we get no risk of flooding using the building footprint. So no risk of flooding for any of the types of flooding. But if you were to use a buffered score, you would start to capture the flood risk from the other side of the building. So something you can look at as well is the kind of the context of that flood risk. So if we look at the elevation profile, so this is looking at the elevation profile to the nearest river, which happens to be over here, the River Wandle. Oh, sorry, or is it Wardle? But what we can see is that there's about half a meter, so not a huge amount of elevation difference, but it's actually quite interesting, that elevation difference where it actually first goes down and then comes back up. So the properties here are actually lower than that river as well. So certainly if you were insuring a property in this area with this high risk, and you look at the elevation profile and you notice that the river is actually at a higher elevation than the property, then that's certainly cause for concern. And luckily, these are mainly residential properties, and they're covered by flood re. So that's something we can provide for kind of property insurance as well. So certainly high flood risk, especially since they're below the level of that river. So I've got another property here a little bit further north in Sheffield. And what we see here now is that it kind of looks like there's no flood risk for this property. So we don't see anything in the river overlay. And actually the river itself is quite far away from the property. So if I just measure the distance, we can see that it's about 450 meters away from the nearest river. And that's what we see with flood risk in general, is that river flood risk is limited to being near rivers, coastal flood risk is limited to being near the coast, but this property is actually impacted by surface water flood risk. So if I switch on the overlay for surface water flood risk, we can see that this is kind of a very traditional way that surface water flood risk presents itself. So what you see is, I'll actually make it a little bit less opaque, so a little bit darker. We can see that there's this natural pooling of floodwater in the natural low points in the terrain, especially along the impermeable surfaces like the roads. So we see that this property is very susceptible to surface water flood risk. So in case there's a big rainfall event, you would expect to see some pooling along the road, which is expected to impact this property as well from a surface water flood perspective. But by using the building footprint, you get a good picture of that, especially if we were looking at these properties here, where the flood risk is predominantly the surface water flood risk, so it's pooling along the road. These properties may not actually be impacted by it, but if you're using a buffered score, you would start to see that being flagged as well. So I'll have a look at another property as well. I'll just turn off my flood risk layers, and I'll remove my existing analysis. So So I'm not much of a football supporter, but I did hear that just recently Manchester City didn't do so well at Bournemouth. I don't think anything occurred after the match, but certainly there's always a risk that something could occur. So what you might be interested in is to know what policies you had on cover between the Vitality Stadium and the closest train station, so Bournemouth train station, in case something was to kick off. So we can actually get that quite easily. So we simply draw a route along the most likely road for those supporters to have gone down. So we're just going down here to the train station. So this creates a line. And what I'm just going to do is I'm going to buffer out that line by 50 meters. And what we see then immediately is that the risk count within that buffer of that line is 28. So we have 28 policies on cover along that route. So if there was an event happening along that route, you can very easily pull out the potentially impacted policies. So you can pull that out, you can see the total sum insured, and you can also export that out. So you can export the data out, so that exports it out into an Excel file. So you can do kind of further analysis off the back of that, or kind of notify those customers to let them know that we're aware of the situation and just reach out as a point of contact. Another thing that's impacting this property or the Bournemouth Stadium is we can see that it has two issues. One is burglary and the other is vehicle crime. So we can have a look at the crime scores for that property. So it's high for burglary, arson is actually quite high as well, and vehicle crime. So how does the vehicle crime kind of look for that area? So we can see it's quite high here, quite high for Bournemouth itself. Gets a little bit less if you're going down towards the South Bourne. Also, we can have a look at other peril layers as well. So for example, for subsidence risk, so shrink swell is the predominant driver of subsidence in the UK. So this is the shrinking and swelling of clay-rich soils. And we can see that the southeast is very heavily impacted by shrink swell subsidence. And that's something we're going to see increase as well due to climate change. So as we have drier summers and wetter winters, we see an increased kind of drivers for that shrink swell cycle. So areas like Oxford and kind of this kind of Milton Keynes, this belt here will start to become even more heavily at risk of subsidence. So getting your kind of general accumulations when you're quoting on a property is very useful so that you're not overexposed for a certain location. But it's also very useful to kind of understand your overall kind of exposure. So we have a tool called Hotspots built in, which can very easily kind of give you your full exposure from a radial accumulation perspective for your full book of business. So what we do is we kind of every night, overnight, we rescore all of the kind of these hotspots. So we use a kind of a 50 meter or 200 meter or kind of a customizable buffer distance. And we pull out where is, if you were to draw a buffer anywhere in kind of the extent of your book, where would be the most exposed. So in this case, for this dummy book of business, it happens to be Lincoln that's most exposed. So we can zoom in on this area. So this is the 50 meter buffer that kind of causes that the highest exposure. And we can see that we have 281 risks across these two apartment buildings. So with over 300 million in total sum insured. So that's certainly an area that we might be a little bit cautious of. So we are very heavily exposed, either look for reinsurance or we might want to maybe pause underwriting in this area for the time being while we're so heavily exposed. And that's something that can be done quite easily using the map view tool. So what we can do is we can actually draw just a shape around the area that we don't want to quote for. So I'm showing this for these apartments, but this could also be done, for example, if there was a storm event approaching, say Storm Eowyn, and you didn't want to quote for Scotland because Scotland was forecast to be hit by very heavy wind events. You might want to draw that shape around Scotland for just until that storm passes. So when we draw that shape, I can save the shape. So I will call it the Lincoln Flats, and I will save that. And you can then create something called a user score. So I'm going to call it the Lincoln area, and I'll use my Lincoln Flats shape. And you could filter this as well. So maybe you only want to not write commercial properties in that area, or only not write kind of properties with high flood risk. And then you can choose a score that will return for kind of any quotes that come into this area. So I'll just call it D&Q for do not quote. And you can also choose what avenues you want to deliver that through. Do you want it to be delivered through API, so at point of quote, or do you want it to be the user interface, or all possible channels? So I will just create that Lincoln area user score. So that means that any analysis that falls outside of that shape will come back as no data for the Lincoln area, but any quotes that come in within that shape. So if we got a new quote in for that building, we can see that it will come back as D&Q, so do not quote for the Lincoln area. And that's then very customizable from an underwriter perspective. They can have this live for as long as they deem that that's useful to have it. And we also have other tools to kind of monitor exposure in certain areas. So something that we have called monitored zones. So I have one that I've created earlier, which was just for the Lincoln area itself. So it just drew a shape in the same way that I showed for the flats. And you can set certain thresholds. So in this case, I've set 500 million as the threshold for an amber warning and 1 billion for a red warning. So this falls in within that. So if you have kind of any areas, maybe like, for example, London, where you might be, from a climate change perspective, if the Thames barrier was to break, you could kind of set kind of a monitored zone for London to understand your full exposure in case a certain event was to happen, and just keep an eye on it over time. And the final thing I wanted to just cover was looking at filtering. So let's say we did have the kind of a storm approaching. Say we had the storm that was going to impact the central belt of Scotland. We might want to be interested in all of the high flood risk properties that we have on cover. So I can simply do a filter on combined flood. So anything that we've deemed as red. So we don't have a huge amount, but which is good. So we've been using the tool correctly for our quoting. So that means that it's now only showing the 1600 risks on cover that have kind of high risk of flooding. And we can also export those out then as a shape, using a shape. So if we just wanted to get the ones in the central belt here, so we can see that there's 70 with that high risk of flooding, so 70 million, and I could export those out as well. So I'm going to switch back into the PowerPoint presentation. I certainly could spend a lot more time as well showing some of the other features as well, but hopefully that gives a bit of a flavor of what's possible. And we can also come back to any questions that you might have towards the end of the presentation. So I'm just going to represent the slides. So in this demo, I won't go over what we've gone over, but you'll have this in the notes that will be shared later on. And so what it really does support, it supports the underwriting process, pricing, and referrals. So you could set certain thresholds for those scores to decide, is it a referral or is it not? And it can all be delivered through an API or through that user interface. And it gives you the full picture of risk across your full portfolio from an accumulation and from a risk perspective. So you'd know immediately how many properties you have at risk of high flood risk. And then other features that weren't necessarily covered, so you can upload your own data as well and get it immediately scored, and also multiple other data sets that I didn't cover in the demo itself. So a little bit more about some of the stats that we have. So we have seen a 70% reduction in underwriting referrals just by using the tool itself. So because it gives you a much more granular picture of the risk, so you understand it more, so it doesn't need to be referred. Also, a reduction in reinsurance costs. So the more data you have and the more you can justify your decision making, we've seen that reinsurance costs have been driven down because of that. 50% reduction in flood exposure. So the more accurately you're pricing for flood, the less you'll be exposed to it. And an 8% increase in targetable markets. So that also plays into that. So the more accurate your pricing is and your perils targeting is, the more of the market you can target. And 0.7% revenue regain from leakage due to incorrect rate setting. So more accurate rate setting gives you better business. So that gives us so MapView and geospatial intelligence tools like it give you a look of the outside of the building. But then it's also important to look a little bit beyond that building. So to get a full 360-degree view of the entire commercial risk. So that's only really part of the story. So the next is understanding what's actually happening at the property. So what's inside the building, who's occupying it, and who's behind the business being insured. So let's have a look at those. So the occupancy and business activity. So that's something that isn't captured by maps or perils data alone, and it's arguably the most complex factor and the most important factor in understanding that commercial risk. So to show that, I'll show you a tool that we have called Flyreel. So Flyreel is a tool which allows a user walk through a property with their phones, and it's essentially a guided survey, and it allows them to capture key details. So insurers, MGAs, or brokers can understand the space without the cost and hassle of sending out somebody on site. So this was initially driven from our US business, where they do surveys like this for all property insurance, so even for home insurance. So it was very costly for them to send out a surveyor just for home insurance. So they're getting the end user to walk through the property, and it provides a guided survey. And it ends up creating a floor plan of the property. And it also highlights any perils that might be associated with it. But due to the success of the tool, it's also been ruled out for commercial property. As you can understand, it's a little bit more complex with commercial property because there's just more types of commercial properties. But by having the inside picture and it guiding the end user through that, it really gives you a good view into the property itself. So a full 360 view of the property. Then other things, looking at the full picture. So the next layer would be looking at the tenant and the business validation. So who's actually occupying the building, their trading history, their credit signals, their sector classification. And all this can reveal concentrations of risk that property data alone can't see. And then the final layer is people data. So the individuals behind the business being insured, directorship records, adverse final indicators, identity signals. So that's where kind of fraud prevention and risk selection really start to converge. So when you bring all of these layers together, location, occupancy, tenancy, people, you move from a static view of just a property to a dynamic live view of risk. And that's certainly where the industry is heading, from fragmented data to integrated intelligence, from reactive underwriting to proactive data-driven decision-making. And to bring it all together, so the gap in commercial property is real and it has a cost. It shows up in mispriced risks, inconsistent decisions, and claims that could have been anticipated and avoided. But the opportunity is also real. So the tools and data exist today to close that gap. And these can be accessed at the point of quote across the life cycle of that insurance continuum and through a single integration. And I think firms that move first on this won't just underwrite better, they'll win more business and especially the right business as well. And then they'll walk away from more of the wrong types of risks. So hopefully that's been useful as an overview. So then if there is any questions, please put them into the chat or the Q&A feature. I think there's a few there already. And I'm also happy if anybody wants to reach out directly, so my contact details are there. And I think there's going to be a feedback survey as well. So if there is any feedback on the session, that'd be great to hear back.
Fantastic. Thank you, Heike. We've actually had a question come through already, and I'm going to jump on it from Hannah, who firstly starts with saying congratulations on the excellent work and thank you for delivering such an insightful session. They wanted to ask how the vehicle crime rate metrics are calculated. Are these figures derived from publicly available data sets, or do you also incorporate third-party data sources into the analysis?
So the main crime statistics that we use are published by the Police UK. So that is publicly available, the raw crime data. So really where our expertise then comes in is kind of deriving an actual score from those crime statistics. So what we see with a lot of crime models is that they're simply highlighting places that have a lot of cars. So it's not really fair to just highlight those areas, because you'll end up with kind of the urban areas being very kind of highly rated for crime. So where we come in is we do our kind of our normalization from a geospatial perspective and our modeling from a kind of a geospatial perspective. So we give a kind of a 1 to 10 score on the actual likelihood of kind of crime occurring in an area.
Fantastic, thank you. And I hope that's answered the question. If you've got any follow-up to that, please let us know. Just a reminder, fantastic, thank you so much from Hannah there. You can use our chat function or the Q&A function to ask your question. I'm just going to jump on one actually, because it's very similar to what Hannah asked and maybe just covers off a few extra areas that we've had submitted in advance. While if anyone's got any questions, they pop them in the chat function. Obviously, during the session, you've highlighted the importance of understanding what's happening inside the building as well as the physical structure itself. Yep. Now, you may have touched upon some of this answer already, but where does that data come from? And how confident can underwriters be in its accuracy and currency? So like I said, you probably touched a little bit on that answer already, but anything to add on that? Yes,
certainly what we're seeing is that a lot of the data from outside of the building is becoming very readily available. So like the likes of the Ordnance Survey are producing very good data sets and very accurate data sets, because that's in some ways very easy to do. All you need to do is fly an airplane over that property and take a picture of it, and you can get a very good view of the outside of the property. Where the challenge starts to become a lot more difficult is the inside of the property. So it's a lot more difficult to get a unified view of all kind of internal properties within the UK. So that's where tools like Flyreel, which kind of incentivizes the customer to kind of work with the MGA or the insurer to kind of work together to assess the risk more accurately, kind of come into play. So it's data that can't be kind of very easily created, but it is something that can be done kind of in collaboration with the customers. And I think it gives a best outcome for everybody as well, because you're pricing it more fairly and more accurately, and that's a better outcome for everyone.
Fantastic, thank you. Can't see any more questions coming through from our audience at the moment, but I'm going to just touch upon another one that we had shared in advance today that asks about what impacts from climate change do you see impacting the property insurance market first. And I know you kind of talked about some of the issues of climate change in the session, but perhaps what impacts do you see impacting the property market first?
Yeah, we see that. So we work quite heavily with kind of climate change data, and the few things that we will see in even the quite short term is around flooding and subsidence. And one thing that we've seen in recent years is around flood defenses. So we've seen some kind of flood defenses fail. So as part of Storm Babbitt, there was a flood defense up in Scotland that failed. So we're starting to see these kind of infrastructure being put on strain due to these kind of extreme rainfall events that are occurring. And that's going to get worse and worse with climate change. We will see a gradual increase of other types of flood risk as well, as we see kind of wetter winters and drier summers. And then with something that maybe isn't so kind of well understood or kind of so widely publicized is potentially the impact from subsidence. So we see that every year that we have a very hot summer, as we have a big spike in subsidence claims. But what we'll see with climate change is that will no longer be a spike, where that's probably going to be the normality of kind of those subsidence claims when we have kind of these hot summers on a very regular basis. And we'll see that risk spread as well out of these traditional subsidence areas. So kind of spreading a little bit further north as kind of the weather to drive that shrink swell cycle kind of is kind of more inland, kind of away from the southeast, which is kind of traditionally the areas for subsidence risk.
Fantastic, thank you. That brings us really nicely to almost 2 o'clock. So right on the hour, perfect timing there, Heike. I think a lot of really interesting detail and fantastic demo of what you've got available. If anyone does have any follow-up questions for Heike post session, you've got his contact details, or you can always ask for us to put you in contact with Heike. All that's left for me today is to say thank you for Heike for his time today to talk to you, our members, and thank you to our members for coming along and listening and obviously signing up to our sessions. Please do continue to have a look at our offering under our program of Learning Insights. I've just dropped a feedback link. As always, we really value your feedback, and thank you to all again, and hope you enjoy the rest of your day. And some lovely weather. You mentioned the hot weather, some lovely weather forecast for the next couple of days. So I do hope you will get to enjoy the lovely weather if you're here in the UK with us. So thank you again, and enjoy the rest of your day all.
Excellent. Thank you very much. It's been great.
Thank you.